All right, Rob, well, why don't we get you started? So everyone, thanks for joining, either live or if you're watching the replay. I'm really excited to have Rob Anderson. He's the founder of BV Capital, to talk real estate investing with us. And obviously, this is a broad and very nuanced topic. And I think Rob is a really kind of refreshing voice. And, I always like to say with finances and this stuff, there are people who are simplifiers and complexifiers. It's usually the simplifiers who understand things a lot better and just have a really good strategy. And from talking to Rob, I've just learned a lot and kind of view him as this type of voice. So I'm excited to have him joining us here, talking about, kind of a full range of topics within real estate investing, that I'm excited to hear about. And so, Rob, thank you for joining us, and I'll turn it over to you.
Appreciate that, Jordan. I'm going to go ahead and mute take my video off so I can focus on the presentation here. So if everybody can see my screen, this is my agenda here. Is what Jordan challenged me to do is bring some really educational things, maybe things that you haven't seen or heard of before. And that's really my goal with this presentation. As well as obviously I got to tell you who we are and what we do, but that'll just be a piece of it. So the real estate asset classes, there's a lot of conversation about where should you put your money, where should you not, what's in favor, what's not. I want to talk about that. We invest predominantly in Texas, so I want to explain why. And this is different for everybody, but real estate is local, right? And we have a thesis out there. There's a pending supply and demand imbalance in housing. And so I want to talk about that and show you guys some statistics to also explain, why that is. And as an investor, what do we do with this knowledge? How do we take advantage of it? And how do we obviously create a nice return because of it? I'm going to share with you who we are. And then next, there's the IRAs out there are a really neat avenue to invest because you can do a Roth conversion at a discount. And a lot of people aren't aware of that. And so this may not affect everybody, but if it does, it'll be pretty impactful if it does affect you personally if you're trying to do this. So I got to make sure I share this because the way that you do it is through investing in ground up construction. And ground up construction can be a little scary to some. We think it's fantastic because they have phenomenal returns. And I'm going to explain some of the things that you may or may not have seen in ground up construction as to why we have shifted that direction from the typical, what they call value add play, where you buy a property, you renovate it, you try to grow the cash flow and then sell it for a profit. 1031 exchanges are a big deal. I always want to talk about that, especially reading Jordan's blog. I know a lot of you guys are probably landlords, and that's a great thing to do. I did it for a number of years myself. And then there's at some point, though, you want to stop getting the phone calls. And that's when people will switch into the DST space. And so I want to explain that to everybody, as I think it could be impactful depending on where you are in your investing career. Then I'm going to try to wrap this up in 25 minutes with some Q&A for you. If I actually get the 25 minutes, Jordan, that will be a first, but we'll see what we can do here. Okay. First off, this is not a solicitation. This is not an offer to invest. That can only be done through a private placement memorandum where you read all the risks and see everything that you need to know and ask all the questions before you ever give anybody any money. And I hope that that is explained to you guys, no matter who you talk to. I'm also not a CPA, so I am going to talk some tax because there's a lot of benefits from the tax code for real estate investing, but you obviously need to consult your own tax professional before you do anything. Okay, now that we got that out of the way, where do you invest? And so this is an interesting one here. This is the case for real estate. And this is not new news, but I love showing the charts and the graphs on this. Professional investors have dramatically increased their exposure to alternatives over the past, call it 10 to 20 years. And if you go back to the early 2000s, it was very normal to only have about 10% of your money in an alternative. Let me step back for a second. What we do is we're looking at what we would call the professional investor group of people. So the chart I have in front of you is primarily state and local pension plans. You've probably heard of CalPERS or TexPERS or pick your state. These are some of the largest pools of money. You also have insurance companies that They back up all of their obligations to you from a general account, which invests in things, and a lot of times they're spread around in things like real estate. You also have your foundations, your endowments, you have your Ivy Leagues. The Ivy Leagues have been popular for a number of years as a case study because they jumped into the alternative space first. And so it's really interesting when you look at the quote unquote pros out there of investing and how they break up their asset allocation. I think for folks not nearly as rich as the billionaires out there, it makes sense to look at what they're doing, right? And over the last 10 or so years, access to alternatives has gotten a lot easier than it was in the past. So this is a neat chart. You can see this came from UBS here, but you can see alternatives have risen for the pension plans up to about 35%. The Ivy Leagues, foundations, and endowments is currently around 45 to 50%. So just to give you guys an idea, that's how much they've pulled out of your traditional investments like the stock market, the bond market, mutual funds, ETFs, money markets, etc. So I just find this interesting I always look at this when you're looking at, now, what is an alternative? I probably should mention that. An alternative is anything that's not in the stock market, the bond market, or a money market type bank CD type instrument. So they're not publicly traded. Alternatives are typically private investments. Most notably, a private placement is how you get into them. So real estate is the number one alternative out. Real estate is still about, I don't know if the market share is right now. Last I saw, it's about 50% of the alternatives market is real estate. Some other things that could be an alternative would be private equity or venture capital. Crypto's come on the scene lately. Oil and gas, that's another one. So these things that you can invest in that are not something that you can go on Schwab or Fidelity and just buy it. That's probably a good example for you. Those would be alternatives. It's an alternative to the normal markets, such as the stock markets that we see. Now, considering real estate is the largest chunk of investments, now that you are alternatives, if you buy the thesis, we should all have more alternatives in our portfolio. And if real estate's the biggest one, where do we go? Now, this is a pretty busy chart, but I think this is a great chart to still kind of explain all the different ways you can invest in real estate. And what I'm showing you here are the investment vehicles. I'm not showing you, I'm going to go buy a rental house from a prior investor and I'm going to run it correctly and make money. That's different. That's a personal asset. If you look at the bottom here, this starts with, this is kind of a risk return spectrum, right? And so the lower it is on the chart, the perceived less risky it is, the higher, the more risk, but also the more return. So you've got your debt obligations, your senior debt. These are like mortgage-backed securities. A lot of these you'll see in your fixed income bond investments. And, a lot of these are, it kind of reminds me of 2008, but a lot of laws have been put in place to protect that. But anyway, so people will invest in mortgages through the debt markets. And with the current safeguards in place, they are rather secure. Next, you might have heard, if you go up, you've got core plus value add, and opportunistic. You may not know what those are, but if you look at this chart, just think of it in the terms of a risk return spectrum, okay? Core would be something that the REITs would invest in, right? And so a REIT is a real estate investment trust. It trades like a stock, and it owns a bunch of high trophy class real estate, like a downtown office building or Ritz-Carlton, or the nicest building in town, like an Amazon leased building or a lease to ExxonMobil, something like that would be considered core, right? Like it's a core fund. It's not going anywhere. I don't really have to worry a lot about it. A Walgreens, that would be another one, right? Things like that. And they're generally in the heart of a major city as well. Core plus, so if core would be the golf analogy, if core is the fairway, core plus is the first cut. It's just not fully in the rough, it's just outside. And so it's maybe not in the central business district, maybe just a little bit outside. It doesn't need a ton of work, but you can get a little bit more upside if you do kind of polish the apple a little bit. For example, you don't need to do a full renovation. The property's maybe 10 years old. You just kind of need to, put some new paint and carpet in it, right? Just something to make it a little nicer. And by doing that, you can get a little bit better return than you could by buying a core asset. A core asset, you have no work to do. It's baked. It's fully put together. You just want to own it. So that'd probably be the best example between core and core plus. And those are typically your fixed income environment. Those are your income plays. As far as your growthy type plays, you're in the value add and opportunistic space. Now, if you go to the far left of the screen, you'll notice we left the public vehicles and now we're in the private vehicles. So we left the things that you can just go buy through your brokerage account, and now you have to have access to the private markets, which has opened up dramatically over the last 10 years. Value add, you buy an existing property, you release it, you renovate it, you do something to it to create more value, and thus you grow your net operating income, you grow your cash flow. By the way, if nobody's ever heard of this, NOI, or net operating income, is real estate's equivalent to EBITDA. So if you ever look about how to, evaluate a company or stock, it trades on EBITDA, right? Well, that's how you look at real estate. It's NOI. So that's one way to just kind of compare. So you always want to see, what's the NOI? Where is it now? What's the NOI growth? That's the most important factor. So that's value add. That could be also, it could be something that's in the suburb, right? It's still in a major market, but it's not, in the hottest part of town. Opportunistic is pure development. Opportunistic does not matter where it's located. It could be downtown, uptown, suburb, anywhere, but it is development. You're knocking something down and rebuilding something different. Or you're taking raw land and you're building something and turning raw land into an institutional asset that somebody wants to pay a lot of money for someday. And there's some examples here. That's the highest upside, does have the most perceived risk, but it is the highest upside in the business. That's what we do. We feel if you're going to take risk, you should be rewarded for it. The other vehicles, we would argue you can find in publicly traded instruments, because when you go to the private markets are 100% illiquid. And if you're not going to have access to your money, if you're going to tie your money up for a certain period of time, you should have the opportunity to have a better return. There's something called an illiquidity premium. And it's a fancy term that says, if you invest in something and you can't just a mouse and get it sent back to your account, in other words, you're kind of stuck until it's ready to sell and liquidate by somebody else, it's illiquid, you should have an illiquidity premium. You should make more money. You should have a better return. And that's one reason people like the private markets, is they generally will outproduce the S&P 500 but by a good measure, frankly, if you're going to take that type of risk. Okay, so where to invest? I'm a homer. I live in Dallas. I grew up in Houston. I have a family in San Antonio and Austin. So I've been all over the state. And I'm just kidding about me, but why is this important to you guys that may not live here? Number one, it's a tax-free state from an income tax perspective. So if you invest in a private offering somewhere else, you will most likely have to file a return in that state. And so that's one of the things that you look at. So we have investors from all over the country because they like to invest here because they don't have to file a separate state tax return because we don't have one. But the main thing I show you this slide for is where to invest in real estate is primarily where there's job growth and where there's population growth. Job growth and population growth. You have those two drivers behind you. You have wind in your sails more so than just the fundamentals of the deal. So we always like to brag on that. We talk about it. It does help. More people are moving here than anywhere else. But and obviously we've got 53 of the top Fortune 500 companies here, and that just brings more jobs, so which brings more people. The next thing that's interesting is the U-Haul Growth Index. If you've never seen this, this is an interesting one, and what it does is it measures one-way U-Haul trips for people moving, because this is the do-it-yourselfers. Now, when people move across the country, about 50% are do-it-yourselfers, 50% higher movers, right? And so that's a different index. It's roughly the same, though, as this one. But the U-Haul index is really easy to find out because they publish it, because they want you to remind you of who they are. Well, this is interesting. Texas has been the #1 growth state 6 out of the last 8 years, and the last 3 in a row. What that means is there's been more one-way moves here than other places. And why I like the U-Haul index is it's net moves. Because you can have a lot of people moving in one direction, but you have a lot moving out too, right? And so there's a lot to see there. And they track net moves, which is one thing I like about the U-Haul index. So once again, when you look at real estate, if it's not in your backyard, now I'm going to caveat this. If you're doing real estate in your own backyard, that's totally different because you know that inside and out. Jordan and I have talked about that where he lives. He knows that market inside now. I could never invest in Buffalo. I don't know that market, but he does. That's different. If you're going to invest with a sponsor and you're kind of going to put your trust in that sponsor, what I'm recommending is make sure there's job growth, make sure there's population growth. And it won't de-risk it, but like I said, it does put all the factors in your favor. One last slide here on headquarters moves. This is an amazing slide. So I live in Dallas. The amount of people that have moved here just still blows my mind. Our traffic is a disaster, but that's just me complaining. This is an interesting slide just to show in the last 10 years how many companies have relocated to the Lone Star State. Once again, I'm just banging that drum for the job growth, and other places around the country have good stories as well. This is ours. We are leading the country right now. So we're going to argue we've invested outside of the state. We're not saying that we won't, because we're investors. And when we open a deal and offer it to you guys, we just want you to invest alongside of us. And hopefully you appreciate our investment thesis and the way we execute. But when your local network is in a market that is doing this well, it's kind of hard to leave. Okay, this is an interesting one. For all of you on this call, if you drive around town, you will probably see a lot of cranes in your market. You'll see a lot of construction going on, and you'll think, oh my gosh, there's so many new apartments going up. There's so many this or that. Well, what you may not realize is due to the Fed raising 525 basis points, the capital markets have pretty much frozen. And transaction volume is down, I want to say over 60% the last time I looked at it. And the reason is people cannot get new deals funded. And this is a lot of opportunity, right? So when you see things like this as an investor, it should trigger a little bell in your head that says, well, wait a minute, something's not working right. There's probably opportunity somewhere, right? And so 21 and 22 had sizable construction jobs get off the ground because debt was cheap and we were sitting on our hands for all of 2020 wondering what this COVID thing was all about. So nothing really happened there. And so there was a catch-up effect in 21 and 22. And we had, because what you may or may not know is the United States is 3 million housing units short of what we need to house our current population. I don't know how we got in that situation. I can't go back that far with you, but we are short with our single family and our multifamily or whatever type of housing arrangement you want to look at. We are short. And that's why you're seeing so much building going on. You know, our 20-something-year-olds, they don't want to go stay. A lot of them actually don't want to stay home with mom and dad. They want to move out, but there's only so much supply. And so what's interesting is there's a lot of building going on, but what you're seeing is the finishing up of the projects that are already underway. And so because of the current capital markets and the lack of funding, deals are not getting off the ground. A lot of deals are funded by big shops out of New York, and they've been pencils down for about, gosh, almost a year and a half now. It's amazing. I mean, you can kind of just track it with what the Federal Reserve raises. And the reason is there was this giant concern that 2024 was going to be this recession and we don't know what to expect. And, you know, the soft landing was out the door. And what's interesting is now the soft landing's back. And now we can't figure it out. And so because through the majority of 2023, the money sources out there were convinced that 2024 was going to be horrible, so they quit lending money. And they just quit lending money. The other issue that's happening is with banks. Banks are losing their deposits to money market funds. Well, banks lend off of their deposits. So when their deposits are down, they can't lend as much. Their credit committees have really pulled in what they can do. And so your loan to values are down, your interest rates are up, and the people that fund a lot of these deals are not interested in funding these deals. And so projects are not moving forward like they used to. And so I have some statistics on this slide. You can see Houston, Austin, Dallas, Fort Worth, how much the starts are down by. Now, this is multifamily starts across the state of Texas compared to 21 and 22. So what's interesting about that is you'll see reports that show permits. And I just want to clarify, just because somebody issued a permit does not mean they're coming out of the ground. All they did was get approval from the city to do their job. It does not mean they're funded. That's a big point I want to make. I'll give you an example. We've got a project outside of San Antonio that we were doing, and we got approved with 4 other shops at the same time. And so we're sitting there thinking, okay, so there's 5 of us coming out of the ground. All 4 of those other shops called us to try to sell us their dirt. They got permitted, they got approved, they're going nowhere. We're out of the ground already. So just to give an example of what we're seeing go on right now. When you have this big of a drop in new multifamily starts, what you're seeing going on now, once it finishes and leases up, there's nothing coming behind it. I say nothing. There's very little coming behind it. And so what's going to happen is if you're in a place like we are here in Texas where people are moving here, and arguably a lot of the country is going to have it just from population growth naturally, you're not going to have the housing. And so supply is going to overtake, demand, opposite is what's going to happen. Demand is going to overtake supply, and you're going to have this imbalance. And when you have more demand than you have supply, rents go up. When rents go up, your net operating income goes up, your cash flow goes up, i.e. you can sell for more money because the cash flow is higher. That is pure and simple the thesis of why we're in ground up construction, and you're going to see this going forward. You're not going to see it in 2024. And 2024 is going to be a lease up year for all the projects that got kicked off in 21 and 22. You will start to see it in 25. You'll definitely see it in 26 and 27. Why does that matter? You got to think about your investment time horizon, right? If you're going to put money in a deal, when is it going to be leasing up? When is it going to come out? Especially if it's in a multifamily sector like I'm talking about. You're going to want to know the time frames and what the macroeconomic impact of it is. Okay, so I went pretty long on that. I just really wanted to share what I think a lot of people miss in the investment world. So I'll speed my little part up. Bridgeview. BV Capital is part of the Bridgeview family of companies. And this is by far and away the absolute ugliest slide I've ever had in a slideshow. I'm going to have to talk to my marketing people. But just real quick, so we've got about 950 accredited investors right now. The slide's a little old. And about 100 and I'd say about 90 investor equity. Now, that's not true. We just returned a bunch of deals. We got out of 2 deals recently, so we returned some equity. So this actually may be accurate, around 180. And I'll show you our track record real quick. We are a vertically integrated company. That's important. You should never invest in a construction deal where they don't have their own construction company. I don't think you should invest in a multifamily deal if they don't have their own property manager. We also own our own in-house broker-dealer. That's why you see all the disclosure slide at the front. That's what I run for the company. I've got a team of about 10 people. The development team's about 12 people. Construction's, gosh, they're over like 22 people. They're pretty high. It's just a general contractor. The mothership is where the financial operations and the principals are. I'm one of those housed as well. Lead is our property management company. So it's important in real estate that you're part of a vertically integrated company. We've exited 12 assets. You can see how current my slide is. It shows 9. The reason is the last 3 happened in the last 2 months. And so this is not super current, but out of those first 9 assets, you can kind of see the average investor IRR, average investor multiple, and the time. I've been securities licensed since the 90s. I still hate IRRs. IRRs, internal rates of return, are misunderstood over and over and over, and they can be manipulated because they're time based on when money comes out. So I just wanted to just let you know that. I think one of the cleanest measures to evaluate a deal is the combination of an investor multiple with the hold period. So if I gave you $1, or if you invested $1 here, as you can see on average, we've given $2.27 back, and it took on average 3 years. That's how you should, I think you should, I would encourage you to evaluate a deal. IRRs can be confusing, and they don't necessarily turn into the same growth. Why do we invest? We want to grow our assets, right? It'd be fun to brag at a party about how great your IRR is, but if you didn't technically make enough return, it doesn't matter. So just something to think about there. As you can see from the slides, we're in a lot of different areas. I'm going to talk about multifamily today because I think it's where you can make the most money. We do healthcare. I've got triple net stuff. We've got industrial. As you can see from this slide here, student housing, office, a fair amount of things that we've done, medical office. So a lot of folks will do one thing around the country. We do kind of everything in the part of the country we know inside and out. So it's a little bit different of a view, but once again, we're not trying to grow into this big behemoth. We're just trying to make good money for us and our investors. Back to this slide. As you can see, we love construction. And we've built a lot and are building a lot. And there's actually 1 or 2 missing from this, I'm noticing now. And so once again, it goes back to that supply and demand imbalance that I've been talking about. that you're going to see. We know we're going to definitely see it here. I think you're going to see it in other parts of the country as well. Okay, so let's get on to the Roth conversion. I teased that earlier. This is a really neat wealth building tool. So first off, in order to do that, whoops, going the wrong direction. Let's compare. So you have a traditional IRA and you have a Roth IRA. So how do you get money in an IRA? You can contribute to it on a pre-tax basis, and then you get a deduction. Well, you guys probably don't. I don't either. If you make too much money, you can't. Most of the way money is in a traditional IRA is it's rolled from a 401k or an old pension plan that you may have had at an employer, or maybe you are your own employer and you have your own plan. Well, if you ever shut that down, then you can roll it into an IRA. Okay, so an IRA, you invest money before paying tax. However, you are required to take it out in what's called an RMD, a required minimum distribution, right? And so they force you to start taking money out at 73. Why do they force you to? Who is they? The government. Why does the government force you to take the money out at age 73? Well, there's this thing called a budget, and they never seem to get it right in DC, right? The reason they're doing it is they want you to pay tax, because you pay your tax when you withdraw that money at current income brackets. I don't know about you, but I don't think current income brackets are going to be any lower when I hit age 73. And so that's one thing to consider, is where will tax brackets be? Now, the beauty of a Roth, or the downside of a Roth, is you put money in after tax. So you put in the money in the Roth at today's tax brackets, but you're never required to take it out. You can pass it to your heirs. And when you do take it out, though, the money is 100% tax-free, no matter how much it's grown. Okay. You can even access your contributions at any time, but in order to get that tax-free treatment, that money has to stay in the Roth for at least 5 years. Okay. And another thing, for those of you who might be nearing retirement age, Roth does not count towards the calculation of your Social Security benefits. Why does that matter? That calculation can make you pay tax on your Social Security benefits depending on how much money you're taking in retirement. If all your money's in Roth, you don't have that issue. I'll give you a quick side note. I met a gentleman at a conference who's a real estate investor about 15 to 20 years ahead of myself. And he actually moved from Dallas. He lived here where I live, and moved to Laguna Niguel in Southern California. If you know that area, it's absolutely gorgeous. And he has a big old mansion on a cliff, and I was talking to him about it, and I was like, I didn't really know his station in life, so I kind of put my foot in my mouth a little bit, but I said, you don't mind the tax bill out in California, huh? And he looked at me and he goes, taxes? I don't pay taxes. I pay everything out of my Roth. I looked at him, I was like, how did you do that? And he goes, careful planning over a lot of years. And he smiled as big as I've ever seen a guy smile, and he goes, I can live anywhere I want. I can't tell you guys how jealous I was when I got out of that conversation. But the point is, you get your money in a Roth, you're not going to pay tax on it. And the sooner you start getting that money in that Roth, the better you will be from a pure financial planning standpoint. But the problem with moving money from a traditional IRA to a Roth is you got to pay taxes, and you got to pay your current tax bill. However, there is a solution. When you invest in a ground-up construction project, and why ground-up construction project? And I'll explain. The main reason is the value's not been created. If you invest in another deal, this doesn't really work. The beauty of doing it this way is, in a ground-up construction deal, it's still raw land. It's the dirt's getting moved around. You might even have sticks in the air or a slab pulled, but you don't have the value created because it's not built and it's not leased. Okay. And so what happens is, if you look at this chart, you invest money, and then when we start construction, it's very easy to argue that value has been devalued. And what we do is we pay a professional company to come out and do a valuation report on it. It's a 30-page report. And that report is then sent to your IRA custodian. And that IRA custodian will then lower your value on paper based upon that report. Well, now you've got a lower value. So now you do the Roth conversion from a traditional IRA to a Roth IRA at the lower value, and thus you pay a lot less tax to convert. Fast forward, we build the project, we lease it up, we stabilize it, and we sell it, and 100% of that gain is tax-free. Let me give you a little bit more idea of what that means. The devaluing could be anywhere from a 20 to 30% discount on what you invested. So if you put $100,000 in a deal, And then we get this valuation that comes back at 70, 75% on the dollar. Then, like the example in front of me is 70, so I'll use that one. It could be higher, could be lower. And then we send that valuation to your self-directed IRA custodian. They lower that 100 grand on paper to 70 grand. So then you're only paying to convert the 70 grand from traditional to Roth. You're not paying the full 100, even though you've got 100 invested, right? So you just took a 30% discount on the cost to convert that money from traditional to Roth. Fast forward, we build the project, we sell it. Hypothetically, let's say we double investors' money, which is our goal, in a 3 to 5 year period. And now your 100 grand became 200 grand, but it only cost you the tax on 70 grand to convert. So that 70 conversion as number is now 200, right? And so if you followed that, you've just made a immense amount of wealth at a discount. And the beauty of that is now you've got 200 grand in Roth that you can turn around and invest in something else. And if you double that money to 400 and then 800 and then 1.6, it's all tax-free money. The government will never get their hands on that. And that's freedom, I think. I'm a big fan of this concept. I do a little bit of it myself every single year. The drawback is it does cost you some money to convert, but if you can do it at a discount, to me, that's valuable. So here's a little step-by-step just to kind of give you a summary of it. You invest in a deal through your traditional IRA. The construction starts. We get a third-party valuation report that reduces the value. We submit that valuation to the custodian holding your IRA. The IRA then custodian lowers your value. At that point, you convert from a traditional to a Roth at the reduced value and thus at a reduced tax bill. The construction project moves forth. It builds it. It stabilizes it. It sells it for a profit. And you now have that profit tax-free, and it costs you less money to convert than it would have otherwise. I get that may take some questions, but this is a really neat concept for anybody trying to get money out of their traditional and into their Roth. I've never seen a more tax-efficient way of doing that. So once again, the best way to do that is in a ground-up construction deal. So what's a ground-up construction deal look like? Well, I have one for you. So New Braunfels is a suburb of San Antonio. Third fastest growing city, actually. It's amazing, probably because it's a smaller city that's just booming. What we look for when we do a ground-up construction deal is we look for barriers to entry. Is it hard for other people to come in and do what we just did? And that's a lot of what we're looking for. This town is very hard to develop in. And what we're going to do in the Texas Hill Country, which is that area in between San Antonio and Austin, it's very hilly. It's a very attractive part of the state. It's a very growthy area. It's booming with a lot of tech and other things that are moving there. I'll give you a Tesla's 35 minutes from this property to give you an example. And so there's a lot of neat things that you could do. As you can see on the right-hand side, the investment metrics are rather nice. Our underwriting goal when we go into a deal is we want to see if we can double investors' money in a 3 to 5 year period. If we don't think we can do that, we're not going to spend the money on the pursuit cost and going after a deal, period. That's just the way we look at it because we're investors too. So that's our underwriting metrics. This deal still has a little bit of money in it. What's neat about it is something called impact fees. I'm throwing a lot at you right now. I understand that, but what's an impact fee? An impact fee is the cost or the impact on the community of a new development. When you go in and do construction, you're impacting that local municipality through added services, right? You need the infrastructure to be able to do it. Think about the utilities, the roads, the electrical, the water, the sewer, et cetera. If you have to get that built out to your property, that costs the city money. So what the city does is they charge developers fees. This particular project had an impact fee of $2.7 million. So you may not realize it, but every city across America does this differently. But every city has impact fees. They charge developers to develop in their area. And it helps pay for things because they can float a bond, but they're not going to see that money right away. And that's what this does. The neat thing about this particular project that we have outside of San Antonio is they've had so much growth. And I'm giving you an example of a barrier to entry. They've had so much growth in that area that the city raised their impact fees 2.5 to 3 times what they normally are. And what they'll do is they'll have an impact fee on school districts, on services, on the stuff that you see on the screen, on roads, on utilities. They all have their own different impact fee, and you add them all together, and that's the bill they give you. Well, the city uses impact fees like a governor. They're trying to slow down growth so they can catch up from an infrastructure standpoint. It's really interesting. And we're seeing that all across Texas right now. And so what they did is they raised their fees. So if we were to go back in today and propose building that exact same project that we're building now, because we've already broken ground, that $2.7 million impact fee would be $6.5 to $7 million. That is a substantial cost that takes your return from a low 20s return to a mid-teens return. Well, at a mid-teens return, I don't know that I'm willing to spend the money to move forward. And that's also impacting a lot of other developers in the area. And that, my friends, is a barrier to entry. They're not going to go in because the cost now just became a little too much to develop. And so what that does is that reduces your competition. If you can come out of the ground and you're all by yourself, you're going to be able to demand the rents that you want. Last thing on this is our land price per door. The way you evaluate land price when you're looking at multifamily is the cost of the land divided by how many units you build. Normally, in this particular market, a good buy on land would be a cost that would equate to $20,000 per door that you plan on developing. We were able to get in the high 14,000 range. So I've got a really good basis on this land. This is one thing that developers look at, are impact fees and price per door when they go in to build a potential multifamily property. So I'm just trying to give you guys some background on how to look at deals and how to evaluate stuff. And it's what we do when we go in. Beautiful property. We're doing a farmhouse style build, which is a little unique. And we've got some really neat things. We're building pickleball courts. Any of you guys play pickleball? It's amazing how big of a rage that is. We have 3 pickleball courts we're doing in this community. Why? Because this community is a very outdoorsy community. They've got rivers that flow through it. People float the rivers. They've got lakes. They've got hiking trails. They have an Oktoberfest that's the biggest in the state of Texas, and it's in this big German pavilion. It's kind of funny. But that's just the community. So we try to match the development to the community. And one of the funny things I think, I can't wait to see this built, is we got 3 pickleball courts on site for these folks. Here's a different type of example. This is more urban. This is what we would call a wrap project. If you don't know what a wrap project is, it's not a type of music. It's a parking garage wrapped with units. So you've all seen these in the denser parts of wherever you live. You'll have the multifamily properties that are very dense and they're higher end. Because what you can do is you can go up the parking garage, you can park on your floor, you can walk out, and then you can walk down an air-conditioned hallway to your unit, just like a high-rise condo would be, and you go straight in your unit. So it's much, much nicer. It's much safer from a security and safety standpoint. Very high-end type property, very sought after, and the institutions love to buy this type of property. That's always what you look at. What's your exit? Who's going to buy this when you build it? And so if you're looking at a deal, you got to make sure that whoever you're working with understands who they're going to sell this to. And one thing we look at, average household income is huge in this area, very highly rated school district, et cetera. Same kind of return that I mentioned earlier. Can I double your money in 3 to 5 years? So some of these are renderings because this is not broken ground yet. But you also want to know where it is, right? And so this is a suburb that's a high-end suburb that's close to a lot of things, right? And so it's a upper white collar suburb, upper middle class, I would say, that's got pretty convenient access. That's, you don't want to invest somewhere that's too far out, right? No matter how much money's in that location. One last thing that we like about this is it's in a mixed use development. So as you can see, there's a lot of neat things within walking distance to this property, from restaurants to movie theater to an ice hockey rink to a lot of other things. Once again, if you're in that community, would you rather live in a normal kind of boring garden style apartment, or would you rather live in this, the parking garage, nice, I got 2 pools, and you can walk to amenities, right? And so these are things that we want to look at, is their value. And the institutions will actually put a premium on a property that's walkable like this, because they know that we can charge higher rents. If you charge higher rent, your NOI is higher, you sell it for more. It goes back to my opening statement. Okay, I'm running a little long on time, Jordan. I told you I would. So let me kind of just wrap up with the 1031 DST, and I'll do this quick. In fact, I'll skip a few slides. When you guys are ready to sell a property, you need to evaluate the tax consequences, because you'll have a capital gains tax of up to 20%. You have the net investment tax, which used to be called the Obamacare tax, of 3.8%. And then you could also get some recapture on your depreciation. People don't realize this, but if you do bonus depreciation, cost seg, or all the fancy types of accelerating your depreciation, that can come back on you, especially if within the first 5 years. If you've held it over 5 years, you're probably good. Once again, I'm not a tax person, but that's what we see. But that some of that depreciation expense, the government's going to want back, because they're going to say, well, we gave you that thinking you're going to hold it for a certain amount of time, and you didn't. And then obviously, if you are in a state that's got a state income tax, you're going to have to pay that as well. And so my friends in California generally will pay 40-45% when they sell a property. And so they love the 1031 exchange. 1031 exchange is you sell a property, and then you have, I'll give you the time frames in a minute, but you move into another property, and you can defer 100% of those taxes I just walked you through to a later date. Okay, so what are the time frames? Well, the first one is you've got 45 days to identify when you're going, what you might buy. You can identify up to 3 properties or 200% of what you're selling. But that's the biggest challenge people have, is that's kind of that's a short time frame, right? And so finding a property that you want to own in 5 days can be challenging. Let alone if you're going to put financing on it, that could be even more challenging. Once you do find something and you identify it with your qualified intermediary, I'll explain that in a second, you have 180 days to actually process or follow through on that transaction and buy that property. A qualified intermediary, we call it a QI for short, is kind of like an escrow agent, or a lot of times they're title companies. When you sell property A, you can't take receipt of the funds. If you do, you'll ruin your exchange. The money has to get wired to the qualified intermediary, and they hold the funds and do paperwork for you. And then when you're ready to buy the new property, they then send the money to the title company of the new property, allowing you to buy that property. It's one of the way the rules are written. So if you're in the middle of a 1031 and you need a QI, be happy to share our favorite QIs with anybody that's in this process. We know who's good and who's bad, because we've done enough of these over the years. The reason we know is there's a change going on where at some point you're not going to want to be a landlord anymore, and you want to just invest, be an investor, right? And so you move from actively managed property to a passive property. I kind of mentioned that earlier, but you can do it on your own properties as well. And that's where a Delaware statutory trust comes in. That's a lot to say, so we just say DST for short. A DST is a 1031 fund that allows you to invest in a big expensive property that you might not be able to buy outright on your own. For example, our current DST is $96 million is the price of that thing. But you can go into that on a fractional basis. So if you sell a property for $1 million, you can put that $1 million into as a percentage owner in the bigger, more expensive property, and you 100% satisfy your exchange. And now you don't have any more phone calls. You don't have any more property management. And that's what a lot of people like at a certain stage in their life, when they're ready to not do that anymore. So that is really quick. People that look at DSTs are investors who no longer want an active role. You don't mind an active role? This is not for you. It allows you to go in on a fractional interest inside this trust and still maintain the same tax advantages of deferring all those taxes. And that's why people look at them. You do need to be an accredited investor, and you do need to be a qualified intermediary. However, this could be a very good situation for somebody. I help a lot of people through this, whether it's with us or with other things, just because there's not a lot of knowledge out there about this. So I'm going to speed through the rest of this. This is some of our other stuff that we've done. These are some of our DSTs. And I'm going to stop because I've gone over, Jordan. I told you I would, and I did it. I was the man of my word. So I'm a little long. I'm going to stop and see if there's any questions, and be happy to follow up with you or anybody else on anything I covered today.
Well, that was really fantastic. I certainly encourage anyone, if you have questions, feel free. You can come off mute and just ask, or just pop them into the chat. But that was definitely a tour de force, and a lot of topics that I don't see covered a lot, like the Roth strategy and even the 1031 DST. Even though a lot of us are more familiar with 1031 exchanges, that sort of nuance out of it. So I think that was super helpful. I mean, you mentioned it a bunch of times, but I'm always curious, in terms of thinking about exit strategies, you talked about looking at sort of the institutional investors. Is that really where you focus for, at this point, pretty much all of your projects?
For our size projects, we do. I mean, my San Antonio project's an $80 million build. We're looking to sell that for $109 million, right?
Mm-hmm.
Our Dallas area project is a $102 million build, and we're looking to sell that for around 143 or so. I'm just going off the top of my head. So you're talking those kind of numbers. Yes, those are institutional buyers. It could be a REIT, it could be a family office, it could be a lot of people just want to own these because there's a big belief out there in owning physical, tangible assets,
Mm-hmm.
as opposed to owning a stock that you don't necessarily know what's going on in the boardroom.
Mm-hmm. And then in terms of just at a very basic level, how does that exit strategy impact investors for anyone who may not quite be familiar with that concept? So you're, as an investor, you're giving X amount of dollars to a sponsor to invest, and how does that exit strategy play? And because it obviously is really important, but maybe is not always its importance is not always understood.
Well, they're going to pay for yield, right? And so they're just trying to find somewhere safe. Believe it or not, these folks are sitting on so much money, and they know that it can't just sit in cash, right? The Fed will lower interest rates, and when that happens, they're going to start pouring out of those money market funds, and that's when you're going to see real estate inflate back up again. So they want a safe place to store their capital that also creates income. I mean, that's I hate to simplify it that much, but that's what they're looking for. And then they obviously want the tax benefits that come with it, because these people are wealthy or ultra wealthy, and they're dying to find some tax benefits. And that's why the wealthy own so much real estate. I've seen some of that in your write-ups, Jordan. So I think a good answer to this as well might be the investor experience if you've never done a private placement, right? So the way these work is you're buying units in an LLC, and the LLC owns the real estate, and you are a limited partner. You're a passive investor. So you don't call any shots. You have no liability over and above what you invested, right? And you get quarterly updates. You get a web portal. If it's an existing asset, you might get some distributions throughout the year. On a construction deal, you don't. Dirt doesn't pay rent. But once it's constructed and we sell it, then you get a big pop, right? And so if you put in $100,000 in a deal, it takes 2 years to build, a year to lease up, and then you put it on the market. Somebody likes it, you negotiate, you sell it. At closing, all of that money goes back to the investor, goes back to the deal. And so, Jordan, are you asking me about the waterfall? That might be where you're going with this, and how money's paid out. Okay, I caught you.
Exactly.
And so what'll happen is, at that point, you get a big pop, right? And it feels like you won the lottery for a second, because you got nothing along the way, and then boom, you got a big check. But the way money is distributed is called the waterfall. And this could be in a million different ways. So I can give you my normal waterfall, but what you're going to see is a preferred return. And what that means is the investor will have a preferred status on the first X% of money that comes out of that deal. So we typically have an 8% preferred return. Unless you write me an incredibly large check, it's going to be an 8% return. And what that means is that's not current income necessarily. That just means you have a preferential treatment to the first 8% that comes out of that deal, and it's not a split with the sponsor. You get 100% of it. Then you get 100% return of your capital. And then after that, we do what we call profit splits, right? And that's where you'll see hurdles is another term that people use. But for example, then you'll get paid. Then what happens is you'll split the profits with a sponsor up to a certain return metric. And so our deals, we do an 80-20 split where the investor gets 80% of the profits, and we get 20% of the profits until we return an 18% return to that investor. Above an 18, we then drop it to a 60-40, where we get 40 and the investor gets 60, up until a 24, Once we exceed a 24% return, it goes 50-50. So why do we do it that way? Because it incentivizes sponsorship to get the best return possible for investors, because then the sponsor can make more money. And so in this business, it's very important to put yourself on the same side of the table as your investor. You want to have the same goal in mind, right? You want to be aligned, and you want to have the incentives aligned. And so there's a million different ways you could do the waterfall, but that's the way we do it. So you'll have the return, number one. Number two, you have a full return of your capital that you gave us. And then after that, you'll have some sort of formula on sharing the profits over and above that. Was that what you were asking?
Yeah, incredibly helpful, and I think super important to understand, and especially explaining that preferred kind of aspect, and then how that split is afterwards. Because there's I mean, you know this better than I do. There's a big range in how people will do that, and the incentives are not always aligned, and so you certainly want to make sure they are, like you said. So that's really important.
Yeah, things I'd tell you to look out for is if the developer is getting a share of profits before you've gotten 100% of your money back.
Mm-hmm.
We think that's a no-no, right? Why should we take profits on cash flow or anything else until I've given you 100% of your money back? Because keep in mind, there's a developer fee in here to pay bills while we're doing the deal anyway. So that generally the sponsor is making some sort of fee along the way. They shouldn't double dip. Another thing to look out for is when you get to the profit splits, what does that profit split look like? Are they, is it too low? You know, sometimes, you know, I give you a kind of a declining one. You'll see an increasing one. Well, that means there's probably something in the deal you don't know about. Like, why would they do that? You know, so I'm trying to think of some other things that you can look at there that are a little deceiving. I've seen, so when you see a preferred return that's really, really high, that should equate, there's risk on the deal you don't know about. Okay. The only reason somebody gives you a 12 or a 14% preferred return, because keep in mind, there's zero split. That is money that the developer will never see. That goes to you first. If you ever see a 12 or 14, I want you to stop and reread what you read. Because the only reason that people do that is they have to incentivize people to invest because they're not getting investment otherwise. So something just to, there's a lot of things like this. This might be a whole nother webinar we could do, but there's a lot of things like this when you're evaluating stuff where you just go, that's a little out of the norm. Why is that?
Yeah. Well, that's super helpful. Yeah, and we're bumping up on our time, but I think, like I said, that was incredibly informational and educational, and definitely I learned a lot every time we talk. I do. So I just want to thank you for taking some time out and doing this. I know you're super busy. So thanks a lot. And just, I know you have it up here, but for anyone who wants to reach you, what's kind of the easiest way?
The website really is the best way. We've got forms on the website. If you, I will talk to you personally. Just go to the website, because otherwise you'll get one of my team. Go to the website and just say, hey, I saw you on Jordan's webinar. I have a question, right? Something to that effect, like reference this webinar so I know what it is. And I'll give you a shout back when I get a chance, and be happy to visit with anybody. I love still talking to investors. Like I said, I've got a pretty nice team now, but if I could choose what to do, it'd be just getting on the phone and talking to people. That's way more fun than a lot of the other things I do.
Awesome. Well, thanks again, and thanks for everyone joining. We'll see you later.
All right. Thank you all.
Thanks.